Hello, everyone. Good morning or good afternoon, and welcome to today's webinar on capitalizing on the growing fix and flip market. I am Rose. Now, we want this webinar to be as engaging as possible for you guys, as informative as possible. So as questions come up, please go ahead and use the little questions tool, and I will ask the speakers on your behalf. With that, I would like to turn it over to today's speakers. Take it away, Jim and Lauren.
Well, hello, and thank you, Rose. Hello, everyone across the United States. Glad to be here. I'll speak a little bit, and then I'll shut my mouth and let Lori take over. We'll start off with a slide that's about Lendsure, just 30 seconds on this one. Been around about 10 years. Down there where it says highly experienced management team, that kind of says we're getting old, but not really, not that old, but we've been together about 25 plus years. The fix and flip aspect of our business did not begin in 2015. It began in late 2021. We do loans in about 50 states. The hot fix and flip market is what's going to read next. And I always look at this one and say, why do flippers do this? Why do people, investors, invest in old homes or newer homes that need repairs? Why do they put out a lot of money? One answer: return on investment. So we looked at 12 of our recent payoffs where we made somebody a loan, they fixed the property, they repaired it, they put it on the market, they sold it. We were looking for and searching for sale price and then factoring in return on investment. And of the last 12 deals, the average investor return made more than 26% on his money. So when you take your money to the bank, you're not going to get 26%. But in this business, you can. In fact, some of those were higher than 26%, some were less. A lot of that depends on how you manage the project and the buy price to start with. So people do it for one reason: money, income. It's hot. It's been hot for 3 years. This is on the tip of everybody's tongues. One of the drivers is the aging homes in America. There's a lot of houses out there that need a lot of repairs. Who is our customer? We see this one often. It's a contractor that's been doing work on these properties for the investor, the guy in town with the money. And after the contractor does 4, 5, 8, Lori's seen some where they've done 24 deals, they get tired of watching the investor make all this money. So they get paid for the job, of course, but that income isn't near as much as the profit in the deal. So we see this phenomenon where the investor says, I'm going to go raise my own capital, borrow from my family, my uncle, whoever, my 401k, and do a flip myself. So that's one of our customers. Here's an example of one, I'll turn the page, where an investor bought this property. You can tell from the slide, 44 remodels, so highly, he's been around, knows what he's doing. He's just tired of watching investors make money. So he bought this one himself. Large deal. Had a budget on this house of $350,000. Ultimately had about $1.1 million into it, $1.15 million. Sold it for $1.4 million. What I want to point out is two numbers. The first number is about bullet point 5. It says budget 350 times 15%. That's what a contractor typically earns, 15% of the budget. So he would have made $52,000 and put that money in the bank. As an investor, 1.4 sale price versus 1.150 into it, that's a $250,000 spread. So $250 going towards him, less in cost. There's always selling cost, etc. Let's say he made $200,000 after his cost. That's a lot better than $52,000. So he didn't pay himself, so that $52 goes away, but the $200 goes into his pocket. So that's a very interesting scenario that we closed, I don't know, 5 or 6 months ago. Next, oh, go ahead, Rose.
I was going to say, Carolyn has a question. Yes, Carolyn, I will be sending you a copy of the slides. Look for an email from me, Rose Waldy, about an hour afterwards. You're going to get a copy of the slides. You're going to get the recording of this webinar, and you're going to get some really cool resources that I'll share with you a little bit later.
Another type of investor we see is the strategic. That word means someone that's very fussy about the numbers. They overmanage the project. They're very detailed. Here's an example of one we done where the investor was focused on getting the job done and getting the house back on the market quick. I mean, very quick. So that last bullet point executes a well thought out exit strategy. In this case, it worked out great for these people. They bought this house, next slide, which was a divorce situation. House looks great. Interior is beat up. Maybe something to do with the divorce, I'm not sure, but it was beat up. So they find the property off market, wasn't even listed, a friend of a friend, and they end up buying the property November, I can't read the slide. They bought the property, last year. So we funded the loan in November 23. Skip on down, home listed January 25th, 24. That's a whopping 2 months. They sold it a month later. So the numbers add up quickly, and the time frame boost their return on investment because they got their money back fast. In this case, they sold for 1.6 on a 1.4 investment. So a lot of money back. They took 3 draws out. That's money that we have. Lori will talk about draws in the draw process. So that was their cost to do the repairs. They've done this so fast, their return literally doubles. If you take an investment, let's say of $500,000, and it returns $50,000, you would say, oh, that's like 10% of 500. So I made 10% of my money. When you do that inside of 6 months, and you reinvest that same money in that, call it the second 6 month period, and you make $50,000 again, that original 500 now returned to you 100,000. That's not a 10% return annualized. That's a 20% return annualized. Repeat business in this sector of the market is forever. They're always coming back looking for another loan through you, the mortgage broker, helping them get another loan to do another deal. So it's repeat clients for you. And the last one is the serial flipper. We love those kinds of borrowers. They've done 40, 50 deals. If they bring 3 deals a year, that's a good thing. What's good about it for you? That's 3 loans that you referred to Lori or Darren at Lendsure. And not only do we get paid 3 times, so do you. We love serial flippers. Okay, I'm going to be quiet for a minute and let Lori take over about how to find these people.
Hey, good morning, good afternoon, everyone. Thanks for joining us today. So this is just a quick slide on finding the potential borrowers. You know, you'll get a lot of them, I think, from your real estate partners. The realtors are calling you directly on deals that they're listing, and then the buyer happens to be someone who wants to buy it and fix it. And keep in mind, one thing, I get this question often, when we call it fix and flip, the selling is an exit strategy based on the term of the loan. It also covers fix and hold. It covers both things. So when we say fix and flip, it can also be fix and hold. And when Jim just mentioned, you get the loan back if they are doing 3 or so a year. If they decide to buy it, fix it, and then refinance it, you're getting 2 loans on the same borrower on the same property because they'll come back to you to pay off our balloon. So this slide just shows you different areas in which you can find these customers if they're not coming to you directly from your realtor partners.
Lori, Deborah wants to know, what's your EPO policy?
There is no EPO on these loans. Makes no sense to have an EPO on these loans because we want them to turn over quickly. The term of the loan, 12-month interest-only balloon, no prepayment penalty to the borrower, and no EPO to you, the loan officer. So that's an important note.
Cool.
So this is just a quick slide that you can delve into more when Rose sends this out. But if you go, we've gone on to Facebook and found many group chats about house flippers. You know, there's television shows about house flippers. However, I tell customers that if the borrower says they found you on late night TV on how to flip a house with no money down, you should run from those. These are investor products. The operative word meaning investment, that means they've got to have skin in the game and money in the project. But I know it's no news to you guys that that this is very popular. You know, you can join investment clubs. I know Jim and I have attended a few meetings, whether they're for a lunch and learn or a happy hour, and you run across all kinds of people that go to these investment club meetings. So I would, you know, Google that in your area and see if you can find an investment club to go to see if you get leads there too.
Yeah, and on this one, by the way, this is just a screenshot that looks real pretty, so I can't adjust it. I've got, sorry, Andy, I can't make it any bigger. But basically what I did is I went on Facebook and I put house flipping and then clicked on groups, and this literally was the results that came up. I'm in San Diego, and you can see it starts with all these San Diego things, but these are nationwide. These are tons of different groups of flippers talking about back and forth, discussing deals, asking questions about financing, and you could be there. You could join there, answer their questions, and be a resource that they go to regularly. I think it's a great opportunity. Oops, sorry.
So just some additional details about our product. And, you know, if you've spoken to me before via email or phone, I normally send you our rate sheet because it contains some basic underwriting guidance, which I think is very helpful. This is a product to add to your, you know, to your list of non-QM products that you use. I only handle the fix and flip product. I don't handle the other, you know, products that Lendsure has, bank statements, Boost, 1031 exchange. Those are handled by your other AE. So you, some people have asked me why I have two AEs, and that's why I only handle this product. We accept any level of investor experience. Down payment is based on investor experience. If they've never done it before, it's not a problem. We just want more skin in the game. Normally it's 25% down. I review these immediately. I refresh the portal several times during the day, normally look at it right away. If I'm working on another file, I'll call you, leave you a message, send you a quick email that I have your scenario, and I will get to it promptly. So it's definitely an investor-only product, no primary, no second home, for those people that want to purchase, fix, and sell, or purchase, fix, and come back to you to refinance it into a DSCR. No EPO, no prepayment penalties, no IRLA, no 1003, no income analysis, no DTI, no TRID, no LE, no CD, none of that. They're not considered, they're loans that are not considered covered. They're considered entity loans. And there it is, the exit strategy: sell it or come back to you to refinance it if they want to hold it as a non-owner.
Great. And Donna wants to know, what does EPO stand for? I'll answer that. That stands for early payoff. So if you want to pay off, you can pay off the loan as early as you want without any kind of prepayment penalty. Is that correct, Lori?
Yes. Yes.
All right, fantastic.
After you, Rose, we don't come back after. They're used to, if a borrower pays off, like let's say within 4 months on other loans, then we come back and try to get some of our points back, origination fee, but not on this product. Okay.
Hey, I'm going to ask Lori a question on that last slide. I'm going to ask her now, she'll answer you. There's two exit strategies: purchase and sell and purchase and hold. So talk about the DSCR that we can do.
Right, so the borrower tells us that up front. Now, it's important to note that if they come to us initially and say, I want to hold it, and as a non-owner, and during their rehab, somebody's driving by and says, I want to buy that house, let me make you an offer, they can change their exit strategy, right? We're not holding them to whatever exit strategy that they originally said. However, if they want to retain it, then we will direct them right back to you to go ahead and do that second loan to refinance it into the DSCR. You're not obligated to give that loan back to us, but the reason it makes the most sense to give that loan to us is that we were with you during the purchase and the repair, and although you will need a new appraisal, we're confident about the value and we're not going to cause you any hassle about seasoning of how long they owned it, because we knew what the scope of work was. And again, the beauty of it is you're getting 2 loans from this same borrower within a year, plus their next loan of their new purchase of a new investment property. So it's, Jim calls it something else. I call it rinse and repeat.
Now, Joshua wants to know, what's your average closing time?
So I define that in 2 sections. The first timeline would be once it goes into our scenario portal, and it's about 22 pieces of information. The property does not need to be under contract, but there has to be an address. So in order to generate a term sheet or a pre-qual is 1 to 2 business days. I ask for a 30-day close of escrow on the purchase contract if it's not already under contract. However, we close the bulk of them in 15 to 21 business days. And don't ask me about the handful of loans that we've closed in 7 to 8 business days, because yes, it can be done. And I wear the scars of my underwriting team when I ask for those loans, but that is a situation where I know I'm engaged in the process to get the thing closed in 7 or 8 business days. I know you'll be engaged in that process, and it's about the buyer and the seller. We've actually had 2 loans in the last couple months that were held up, ready to go, because here's an interesting note: the seller wasn't ready to sell. Oops, forgot to tell you we're in probate. Oops, forgot to tell you we're in bankruptcy. So if the seller can sell and the buyer sends us every document, which isn't a lot, that we need to get the loan to underwriting, and we order the appraisal, you don't, and we run fast, you've opened title, we can get those done. So everything can be done easily under 30 days.
Now, Lori, Meredith has a bunch of questions here, but how much experience do you require? What are the cash reserves? And what does the construction oversight process look like?
Good questions. So I think we already answered the first question, correct?
I've got a couple about what level of experience you require. And in fact, I have 3 or 4 different questions around, do you take a first-time flipper? How many flippers? What is the rate for a first-timer?
Got it. So we take first-time flippers all the time. Down payment is based on experience. If they've never done this before, they should expect to put 25% down on the purchase price. So that would look like 75% of the purchase price plus 75% of the rehab budget. If they can evidence 1 or 2 in the last 24 to 30 months in their name or the name of their LLC, we can do 20% down. That would look like 80% of the purchase price plus 80% of the rehab budget. Where we can do the creativity is on that investor that has completed 3 or more in their name or the name of their LLC in the last 24 to 30 months. That would go to 15% down, 85% of the purchase price, plus up to 100% of the rehab budget. So the down payment is what is going to define, their experience is what's going to define their down payment. Important to note, no portion, $0 of the rehab budget is dispersed at close of escrow. Those are holdback funds dispersed in draws as the work is completed and inspected. We've got another slide on the draw process. We'll get to that in a minute. The loan closes like a regular purchase. They come to the closing table with down payment and closing costs, and they own the property. The next day, the work begins with their contractor and that's how we will get to the draw process.
All right, I'm going to ask one more question, and then I'm going to let go through a couple of slides before I answer some more. Is the fix and flip program available for foreign nationals?
It is not. You have to be a US citizen or hold a green card. For a little while, we had the program, and then it was determined that there was an international background check report that costs about $3,600 to run with no guarantee that we would approve the loan. And Lendsure made the decision that we weren't going to do that. So that's a good question, but they're not eligible for this program.
Got it. So talk about guidelines.
Okay, credit scores as low as 660, the higher the better. We've done a few under 660. If you get one like that, start with sending me the credit report, and I'll tell you in a minute if it's something I think we can do. But the minimum score is 660, and that covers all members of the LLC. There's 3 members in the LLC or S Corp. They all go on the loan, they all sign, they all must have the requisite 660 FICO. What they can combine is assets and experience. So if one person has the assets and the other guy has the experience, that's completely fine. We already spoke about non-owner occupied. We go up to 4 units, no mixed use, no commercial, no large acreage. Rural is case by case. Any concern about the property, just email me the address. Let me take a look at it. We spoke to up to 85% of the purchase price based on experience. The loan to cost, again, is divided by the cost. You take the purchase price and the improvement costs and the percentages that we apply to those, and we don't make loans greater than 70% of the ARV. After rehab value, that's another new term that you may hear. Case by case, we can do a little bit over 70 if the appraisal comes back in a little bit low, but you have to start with experience to determine the down payment. 12-month interest only balloon, no prepayment penalty. On the last slide, somebody asked a question about reserves. 6 months interest only payments, that's the reserve requirement, does not have to be liquid. That can be in a retirement account, but we do require the reserves since we're not collecting income or a DTI. The loan size down to 150, up to $1.5 million. It's way easier to get a $2.5 million loan approved than a $145,000 loan approved. There's just not a lot of money to be made, quite frankly, on loan sizes under 150. Normally you see those on cash buyers that they're buying the house for $75,000. They want to put 40 in. Those are cash deals and ones that are very difficult for us to get approved. And if you're going to bring a loan under 150 to us, expect to have the borrower pay us probably 3 to 3.5 points with a 12.99 rate. So if you've got one, call me, we can go through those. Borrower entity, we've already discussed, LLC or S Corp. And I've mentioned this, before you put it in the portal, they have to have a property identified, but they don't have to be under contract. I get questions a lot about the portal link. My recommendation is that you or your sales assistant only enter it into the portal. When you send the link to the borrower, they never fill it out correctly, which isn't a big deal. We can correct it. However, that way you know that the information's going in correctly, listing out assets, their name, their email address, those kinds of fields that we need for this.
Lori, Lisa wants to know, what's the compensation to the broker?
That's a really good question. Let me go back to the term for just a second. 12-month interest only balloon with no prepayment penalty and no EPO. That loan carries no value on the market, right? There's not people standing in line trying to buy those loans from us. We want the investor to make the most money, as Jim pointed out earlier, on their 10, 15, 20% returns. You need to keep your lights on, so you charge an origination fee. I'll use 2% as an example. We match what you charge. So if you charge 2, we charge 2. We match what you charge down to 1.5. Here's something we started doing a few months ago to kind of defray that. Let's assume we agree on 4 points. At close of escrow, I will pay you your 2 and only collect one of my 2. And I will defer my second point to the payoff out of their proceeds when they sell the property or refinance it. They're still paying 4 points, but it does reduce their out-of-pocket costs. The other thing that we've been doing is financing into the loan upfront 1 to 4 payments. What that does is allows the borrower, the investor, to focus on the project and not, oh no, who's my new servicer? I better get set up with them because I don't want my payment to be 32 days late. So that's another piece that we've done to kind of work with the borrower to help kind of defray, some of their heartache about these loans and making sure that the payments are made on time.
So one last question before I move on to the next slide. Phyllis wants to know, is their qualification solely based on assets and credit then?
Credit score, assets, the project itself, right? That's an important piece, which is why we can't do that on the TBD, and their experience. Absolutely. That's what it's based on, those 4 components.
Awesome.
I said the property. Jim just put in my ear location, but that's the property itself. I call it, we are looking for properties in Johnny Lunch Bucket properties in neighborhoods that will easily sell or easily rent. And one other piece before Jim goes to ground up, because I've been getting this a lot lately, has to do with assignment of purchase contracts and wholesalers. In general, we don't accept those because the wholesaler does not want to reveal what they've paid for the property, and we limit how much they can make for buying and tying up a property and not doing anything to the property. We just had one where they bought it for $345, did nothing to the property, and turned around and wanted to sell it for $550,000, and we were not able to get that loan approved. So just important note about wholesalers and assignment of purchase contracts. Yeah, they got all the profit.
So before I talk about something that's newer to Lendsure, and that's ground up new builds, the location aspect of a property in our non-QM world, we always look at that. So as a wholesale non-QM lender, location is important. It's a 30-year fixed rate loan in most cases. In the fix and flip world, Lori gives them a year, then she wants paid off. The problem, the pressure around location is, in a non-QM world, the house doesn't have to sell tomorrow or next month. In our world, the house has to sell. We got a year. So we're very careful around where is the property, location, et cetera. So we take a deeper look at that than we do on 30-year non-QM loans. Okay, what's new? Not the build ground up, new construction, designed for small builders that build 2 or 3 or 4 homes a year. It's not designed for large building companies. This is for the guy that says, I want to make some money, I want to build a house, I've been doing it for 20 years, I build 2 a year. It's for people that builders that build homes on spec, and they hope to sell it when the house is completed. Or the other strategy is they build it to rent it. Either way, we're good to go on that loan. When we look at ground up construction, we're going to start out by getting the builder on the phone with you. First 4 questions that come out of our mouth to the builder are very important questions to see if we can even pursue the idea of doing the loan. First question is, do you have a lot that is a buildable lot? City or county approved? Yes, you can build a house here. So that's like comes back as a yes or no. Number 2 is, at that lot are services at the curb, meaning electricity, water, etc. If those 2 answers are yes and yes, we keep going. The third question is your experience. We require that they have 3 new builds under their belt. And then on an exception basis, maybe two 2 new builds and a whole lot of flip construction experience. That may be considered as well. And the last question we ask a builder is, we start out by telling them, this is a bank loan product. Construction loans in America for the last 60 years, you go to the bank. So we ask them why they're coming to Lendsure. The bank has a lower rate than we do, and they may charge less points origination fee than we do. So we want to know up front what happened that you couldn't get the loan at the bank. Typically, we hear things like, oh, I bought the lot for $250,000 paid cash, took the money out of your bank, but then the bank, when it comes time for the construction loan, they don't consider that $250 an asset. So they run into asset problems. Bank won't do it. Lendsure calls that an asset. Not only on our construction loan do we call that an asset, we'll give them 60% of the 150 or the 250 back as cash to start the project. That would be grading, number 1, and number 2, foundation. So cash goes back, they can start their project. They love Lendsure for that. How much do we lend? Like I said, 60% of the cost of the lot. Then the next thing is cost to build. An architect was consulted for building plans. That's going to cost the builder $10,000 to $20,000 for a set of plans. Whatever that number is, cost to build, let's say it's $400,000. Lendsure will end up to 80%, in the extreme case, 82% of the $400,000. So we make a loan against the lot. No one else really does that except us. We make a loan against the cost to build. So good program, new for us. Lori, myself, and another account exec here who's sitting in front of the camera, you can't see him, Darren Samarel would be the 3 people you would call about ground up construction loans. It's new to us. Hasn't been marketed yet. This is the first phone call we've mentioned it on, right, Lori?
Yes.
So we're looking forward to how many of these we can do. We think it's going to be very robust and busy because I see the market as, from the banks right now, as underserved. So good luck with that. It's new to us, and we hope you send us a deal.
Will we lend in all 50 states on the ground up construction?
We do, but there's limitations in Hawaii and Alaska.
Okay, great. And yes, I will be sending a copy of these slides after the webinar. I know that we've covered a lot of information, so don't worry. Look for an email in about an hour after the webinar ends from me, Rose Waldy, and that will have that for you.
Hey, Lori's back. Really quickly, I think this shows up on another slide, but I did want to mention this. We also will look at a refi, not just a purchase. So borrowers will have purchased the property, maybe for cash, maybe it's currently financed, it's been rented, the last tenant moved out, and they want to fix it in order to rent it out. Maybe they're fixing it up to sell it. So we do look at refi. So when you go to the portal, your choices are purchase, refi, ground up, and that's where the refi come in. We've got to be in first lien position. If it looks like we're bailing out another lender, like they took out a construction loan that's coming due or is past due, those are tougher to get approved. But I always say, if you've got a refi, pick up the phone and call me and let's go over it before you put it into the portal. So I didn't want to mention the refi portion of the program. So quick process overview. The application is really the scenario portal because there is no IRLA or 1003. You have a link, there's no login credentials needed, and you fill that out. You are your sales assistant. What gets generated from that is what we call a term sheet or a pre-qual. It's a full-on, basically, approval. Like if you're telling me the credit score, their assets, and their flip experience, and if we can validate it, we're going to close the loan. So it's like, you tell me, we approve it based on that. You know, if you put down they have 900,000 in the bank, even if they only need 400,000 to close a transaction, we may ask for 900,000 of evidence for a compensating factor. It doesn't mean that it will get denied without that, but when you're asking for assets, ask for all the assets, but the ones that we can validate. Then the term sheet goes out with a couple of other documents. The signed term sheet comes back to us. Currently, there's 3 items we need on a purchase for us to order the appraisal. Reminder, we order the appraisal, you don't, because we get an as-is value, which is normally the purchase price, as well as the ARV or after repaired value. What is it going to be worth when they're done? In order to order an appraisal, I need a signed term sheet, the fully executed purchase contract, and the scope of work or contractor's budget, the line item list of what they're going to do and what it's going to cost. So that's what is needed to order the appraisal. Once we get,
Oh, I'm sorry, Meredith, I hope that answers your question. If you have a follow-up question about appraisals, please go ahead and ask it. Sorry, Lori.
that's okay. So then there's another group of items I need to get the file to underwriting. Your tri-merge credit with credit scores, assets, of course. Assets are looked at like every other asset. If there's large deposit, my underwriter is going to ask for that. We normally ask for 60 days source and seasoning. We get exceptions to 45 days often. They just closed on another property. They send you the HUD with evidence it was deposited into their bank. It's been sourced. It doesn't need to be seasoned. Not a problem. Copies of driver's licenses, social security card only if there's a bunch of credit fraud alerts on their credit bureau. Some other forms called a fix and flip experience form, an exit strategy form, their LLC documents if the LLC has already been created. If not, we can condition for it. It doesn't take much time to create an LLC in the state where the property is located. And so those are the items that we need to get it to underwriting. We ask for an insurance quote, and this comes up a lot. Generally speaking, unless it's a very small rehab project, I need what's called builder's risk. The state farms and the all states do not offer this type of a policy. When I send you a term sheet, I send you an insurance requirements document, and it lists 3 companies that have successfully done the insurance for us. They're not required to use those insurance companies. We highly recommend it. We're trying to close a loan now that came in as a rush. They didn't go with one of our insurance people, still hasn't closed. We asked for a quote last night. We got it this morning. We're moving to close. So we've done your homework for the insurance. So we recommend that you do that. The file goes to underwriting. These are quick underwrites because there's nothing to underwrite. There's no income, right? The term sheet is really the pre-approval, but if we're missing a couple of $1,000s in assets or the LLC documents are not complete, that's what shows up on your underwriting called a conditional loan approval, as well as the appraisal, waiting for that. Then we issue the clear to close. The other question that comes up a lot is who orders title? You do. We order the appraisal, you open title, you send us the title contact information, their name, email address, order number, phone number. Our closing attorney coordinates the closing with your title company. That's the first time you'll see something, a closing statement that kind of looks like a closing disclosure, but it's not, but it's the closing statement. So the borrower knows, what do I need to bring in to close, correct? So that's where that comes in. They arrange for the closing, the documents are signed, fund, and we go on our way.
Okay.
Loan draw process.
What's a draw?
What's a draw? This is how we get money. So important to note, I'm going to say it again, on a purchase, no portion of the rehab funds that we've approved are dispersed. Note that on a refi, because it's cash out, there could be some funds of the rehab dispersed at the close of escrow, but most of the ones we do are purchases. Normally, we do not get involved in dictating what the disbursement schedule looks like because most of ours are more cosmetic in nature. If, for example, it's a ground up or the borrower is buying a property and they're going to tear it down to the foundation and rebuild, yes, we will work with the contractor to come up with a draw process. But in general, how many draws they take is up to the borrower. There's a $150 draw inspection fee, so they should think through that. They're not going to ask for a draw for $500, okay? There's an email address we use for them to request a draw. And these draws are based on the original approval and the original scope of work that we already looked at and approved before we approved it. So the inspection that we order, it says on here something about paid invoices. That's unusual for us to ask for paid invoices. The borrower asks for a draw, we order an inspection, the inspector goes out, compares the work completed since the appraisal was done, and that's how it's determined what the draw amount is. Those draws are wired. A third party does that inspection. I think our draw process is very transparent and quick because there's zero benefit to Lendsure in not speeding along that process. We want the borrower to do the work, get paid, finish the house, list it and sell it, or come back to you to refinance it as fast as they can. I describe it like this. As much as Lendsure does not want to foreclose on our regular loans, you really don't want to foreclose on a property that somebody bought and the next day went in and ripped out the walls. We really don't want that property back. It's our benefit to get them the funds to finish the project and get out of the project.
Keep the money flowing.
Yep, keep the money flowing.
All right. Lori, Cassie wants to know for what property types for both product types. Do we do single family, 2 to 4 unit, manufactured, condos?
Residential 1 to 4 units, nothing past 4 units. Residential in nature. Condos, yes, they're allowed.
No manufactured homes in general, no modular homes in general. Yeah, no mixed use. When I get an email that says I have a unique property, that's when you need to send me the address, because that's when I get scared.
No 12-sided houses.
Okay.
So Rose, on here it says Lendsure fix and flip strengths. These would be a couple things that we do that competitors of ours that do these loans, they do not do this. Lori mentioned the bottom two already, so I won't read those. The one on top says mid-construction stall. We see this one weekly, sometimes more than 4 or 5 times a week. This is an investor that bought a property 2 years ago, 3 years ago, 4 years ago. They decide after running it for a year, I'm going to fix it up now and sell it. They get into the project and didn't realize that some of the repairs that needed to be done when they bought the property. So they run out of money. So they got this property half built, half done. They need another $100,000, and they got some $100,000 private property first. Now they need 200 grand from us. A lot of competitors run from that business. They don't like construction stalls. They're concerned about, will you ever finish the project? Lendsure will look at these, and in fact, we close many of these loans. Often they're new builds. The new build properties 2/3 done, and they're just $100,000, $200,000 short. It's a real niche for us. So you've got a mid-construction refinance situation. Call Darren, call Jim, call Lori. It also says on here, heavy construction projects considered. Heavy construction would be homes where the repair bill's $100,000, $300,000, $600,000. Competitors don't like that. We will look at those. Having done 500 flips ourselves, myself, my boss, a few other people at Lendsure, we've been through the up and down the street, and we've been through this. We've learned the hard way. So our experience allows us to look at heavy construction projects when others do not. Huge niche for us. And as Lori mentioned, we take a pretty aggressive look at first-time investors.
Okay. Jim, what are our rates on average?
I'll give you the range. Low end 975, that's for Mr. Perfect or Miss Perfect. Everything's perfect about the borrower. We like all four parts of the underwrite. We love the location. We love the job. Typically, we don't. How many do we do at 975? Very few.
And that also, Jim, I would mention, that would be for the experienced investor. I'm not going to get a 975 rate
Mr. Person.
on a first-time investor.
So they range, the more typical rate is 11%. We see some as high as 11.99. So that 975 to 11.99 based on the borrower investor attributes.
All right. I've got, is there somewhere we can price out a scenario?
We're building a little engine that you guys can use. It's not built yet. So the best way to price one out, take 5 minutes, input the application on our website, on our portal. It doesn't take long. You'll have a price that's, Lauren could get you a pre-price the same day.
And you can use the rate sheet for if you know the borrower experience, you can know which bucket to price the loan in also. But don't price it in Spark because it's not in there.
Okay.
Rate sheet produced once a month.
Jim and Lori, I've got a couple of different questions about whether they can use these funds to build an ADU on the property. Would you address that?
Yes, we can allow ADUs. Here's the conundrum on those. Since these are investor loans, non-owner occupied deals, business purpose loans, we have no income. So if we did a loan to someone that actually lives on site and we don't have any income documents in file, we're in violation because we did no TRID disclosures. So if they want to put an ADU in the backyard, the front house has to be a non-owner occupied rental as well. It can't be owner occ, I'm gonna build an ADU and rent it out. Both units need to be rentals.
Fantastic. And I've got a question here about, do we provide white label marketing materials? The answer is yes. And in a couple of slides, I'm going to just give you a little preview of what you guys are going to be getting in your follow-up email. And it's going to be a link to marketing flyers, banners, email templates, not just on Fix and Flip, but our other programs as well. People find these very valuable, so you will like these. And how much contingency reserve should be in the rehab budget?
Contingency, well, we better define what that is. For someone that's not done it, Fix and Flip. That's a reserve for the investors to accommodate cost unforeseen upfront. So they think they're going to fix the house for $50,000, but then once you peel some walls back, we call it, peeling off the skin of the onion. Oh no, we found mold behind this wall. It's going to cost us $12,000 to remediate that issue. They weren't aware of it. So we allow contingency buildups. They're typically 10% of the job, between 5 and 10%. So it's an extra reserve in case something comes up once the work starts.
Okay.
One thing back on the Lendsure Fix and Flips. Lori mentioned it, but I can't tell you how powerful that is. When it comes to the origination fee of 2 or 3 points, sometimes 4 points, the fact that we can split that to where Lendsure pays 1 or Lendsure collects 1 up front, and we post date the other point to the end of the contract when they sell the house. When they sell their property, that's a liquidity event. They got a check coming in for the first time in a year. Instead of writing checks, and they write a lot of checks, they're going to get a check, and it's a big one. So to pay that extra origination fee at that point, when they got a big fat check, much easier to sell if you're talking to your investor. And then the other big point she mentioned was the stacking of points, where we literally increase the loan size from 250 to 260 to accommodate the points that you and I charge. This just means less money at the table for them. Huge niche for us.
Okay. Do we want to We got a bunch of questions here. Will Lendsure do ground up construction for an investor who owns a lot and wants to build a house to rent? Owner is not a licensed contractor.
We will allow that scenario. The GC that's involved in the project would require a license. So whoever the GC is, Even if the state says no, and there's a couple states that say no, we require a license.
Okay, fantastic. And here is a link to the application. As you can see, it's pretty simple. It takes this, it'll take you, you just click on next to go through a few fields. And I've got a few questions about how do I submit a scenario and can I have the contact number for your sales team? Yeah, I'm going to provide you with Lori and Jim's email address. When I send, it'll be on slide 2 of the slide deck that you're going to get in about an hour. Or you can simply reply to me, Rose Waldy. Just click reply on that email. It'll go to me and I will have any questions answered, and I'll forward anything that needs to be forwarded to our sales team over to them. So there you go. Is 12-month inclusive of the sale of the property?
It is, but the important thing is that, we've looked at the purchase price and the rehab budget, and we have a general sense of, yes, the project can be finished in a year. If the borrower decides to ignore us, we'll start calling them at about month 8 to see how it's going, look at how many draws they've taken, what's going on, what's their exit strategy. I haven't seen this yet where the borrower just ignores us. The default rate is 24%, so it's ugly. But if you have a situation where your borrower has listed the property and let's just say it's in escrow and is going to close, a month after month 12, we're not going to foreclose on the borrower. We're going to work with them and let that ride and get our payoff. If there's situations where they've used up all their money and they're still not done with the project, then we start negotiating as far as, do we get a new appraisal and see where the value is now? Do we need to redo the loan before the 12 months to give them the extra money to finish the project? So as long as the customer is in contact with us, they're going to be good to go on if the project is a little bit over those 12 months. That's not a problem. We just want people to communicate with us what the plan is.
Okay, great.
Hey, that's a lot better than our old policy on that. When the 12 months came up, we used to make the loan officer from moving to the house and pay us rent. But we got rid of that really fast.
Mm-hmm. All right, Jim, do you want to take us through some of our programs?
So as I mentioned up front, we're basically a wholesale platform working with mortgage brokers and mortgage bankers across America, providing non-QM loans. So I'm not going to talk about these programs, except I'll mention 3. Upper right talks about Boost Bridge, your standard account execs that you work with. The bridge loan is hot. We're doing a lot of those loans. It's designed for move-up buyers that need to get the new house because the wife or the husband wants the new house and they're pushing the other spouse, you need the new house, but all their money is still tied up in equity in the present home. So we pull that money out. We don't charge them any payments on that loan, called the property that's going to be sold or listed. There's no payments on the departing property. So it's hot. It gets people in the new home and it removes the contingency that, oh, my house must sell first. That's a good one to ask your AE about. Asset depletion and asset qualifier, hot product for people that have a lot of money but no jobs. That's a good one. And then DSCR business is off the charts. So that's the no income loan for the investor that owns rental properties.
Okay. So these are the private label resources that I told you about earlier. So that's a link to it, and you'll also get the link within the email itself. But again, it's got flyers, banners, even slide decks that you can use to present to investor groups and put on little webinars for them. And feel free to take some content from our slide deck as well to make those more robust. You can add your logo to them. You can add your contact information to them super easily. So look for an email from me or simply go to lendsure.com/marketing resource kit to grab that resource kit.
Any final questions?
Yes. For a refi, could the loan be settled prior to final payments? In this situation, there's a lead paint abatement that the borrower paid and also paid for architectural specs/plans and thus wants to get money to finish permits to get the contractors working.
That would just fall under our standard initial loan based on purchase price or whatever the value is if it's a refi. The payments for that, for what you just mentioned, abatement issues, remediation, would come out as draws once the work is verified completed. It wouldn't be any different than our inspector going to a house to look at the new garage.
Are you able to do pre-approval on a prospect?
So I'll answer that. That's like a TBD. The project is 90% of the approval. So we may approve a borrower because we like their FICO and their assets and their experience in the project. And we like the property. They go make an offer on the property and they don't get it. So then they don't have to start all over again if you were to send us the address and the purchase price and the rehab costs and the ARV on the new product. I can just go and fill that in. But there's been times where we love the borrower and don't like the property, and we go through 2 or 3 properties before we can generate approval. So it's difficult to generate a pre-qual because I haven't seen the property. So, you know, basically, if they have the FICO score and the assets for the down payment based on their experience, then it is all about the property. So determining a pre-qual without a property address is very difficult. But if you have a particular situation, just give me a call. We can kind of walk through it. I have a pre-qual letter that we can use. But again, these are property-centric approvals, so we may approve one property for your borrower and not another property for the borrower. And because the approvals come so quickly, you know, I get it. If you call me Friday at 3 o'clock and say I need the term sheet so they can make offers this weekend, I'm probably not going to be able to do that, but maybe I'll be able to do it. So those are calls that you just need to make to me.
Okay. Does fix and flip program work on foreclosure sell?
If the foreclosure was not our borrower, yes.
Okay.
And as long as there's not a wholesaler involved. Again, if the bank owns the property and they're taking bids, you know, up until 11 a.m. Thursday, as long as the purchase contract is between the current owner and the current buyer, absolutely, we can look at the property was foreclosed on.
No middleman.
Yeah, no middleman, but a bank-owned property, absolutely.
Okay. Do you allow cash out on the property if we refinance it with you once the fix is complete?
Absolutely. We look to do that because we really don't like to get paid off on loans. So we look to make them another loan and put them into a 30-year fixed.
Well, here's a really interesting one. Do we as LOs need to be licensed in the state?
Well, I wish I could get Darren on camera for that one because he knows the answer.
I think you check with your
Depends by
compliance department. It depends
State
on
by
the
state.
state, yeah. Whether you
Long
have to
answer.
be licensed. Yep, you check with your compliance department if you have to be licensed to close non-owner, non-covered loans.
Yeah, and I think there's close to 35 states that you do not need to be licensed in, so that's good.
Okay, great.
I actually think, Rose, I'm gonna just hedge my bet on this one. I think our licensing map on the Lendsure website covers owner and non-owner.
It does.
Okay, great. And then what are the title seasoning requirements for someone who recently did a hard money fix and flip loan and wants to refi into a 30-year because they want to hold the property for rental?
If it qualifies on income for a 30-year loan, as long as they own the property, they own it. They qualify on income, we'll look at the deal.
Okay.
Would not be through fix and flip though, because you're saying that they're not looking for, the important thing with our unit is the fixed component, right? Fix and sell, fix and hold, refi, fixed component. If there's no fixed component, it needs to go through your other account
It's a
executive.
non-QM loan.
Okay. How does it work without making an offer first? They could lose the house while waiting on approval.
That's true. However, if they know the property they're interested in making an offer on, and I would kind of flip that back onto the borrower. I get scenarios often where they're like, well, I don't know what the work to be done is because I haven't walked the property. Well, as an investor, important key, invest, wanting to make money, how do you make an offer on a property that you've never walked with a contractor or with yourself with experience to know what you should offer, what the rehab is, and more importantly, what is it going to be worth when it's done? So I kind of flip that back onto the investor because, again, I don't know how you do that. How do you make an offer on a property that you know needs repair that you've never seen and you don't know the repair dollar amount or whether or not there's profit in it? So if you have one like that, give us a call and we can walk through it with you. But again, without a property address, it's very difficult to tell you whether we can do the loan. Again, you know if they have a 660 FICO or not, and they don't have any draw credit. You know what they've told you is their flip experience, so you know what their down payment should be, and you know what their assets are. Without understanding anything about the property, that pre-qual I give you is not worth the paper it's written on, because you're going to tell me, oh, it's a 160 purchase price and there's 40,000 in rehab and it's going to be worth 300 when they're done. But after they get their offer accepted, what if it's 100,000 of rehab? Then all their profit just went away. So these are conversations to have with the borrower and the realtor and the contractor, whoever's involved in the transaction, to make sure that the project itself makes sense before they bam in there and make an offer.
On the first timers, what's the LTV percentage you require, and are there any special guidelines?
First timers in general require 25% cash down on the purchase price, and they should have 25% of the rehab budget in waiting, because our approval will look like this: 75% of the purchase price plus 75% of the rehab budget. So if, let's say the rehab budget's 100,000 and I've approved 75,000 in a holdback, they're never getting that 25,000 from Lendsure. That's their additional skin in the game. So first timers just require more skin in the game. They don't bring us the other 25,000, the difference between the total rehab and what we finance, but it's money that they need to have because they're not getting it from us. Does that make sense to whoever asked that question?
Yes. All right. Finally, last question. What documentation are you asking for on their rehab / ground up experience? How do you tell them they actually do it?
A handy dandy fix and flip experience form. They fill it out with addresses. They send it to us, and we go check public records to ensure that those projects were completed in their name or the name of their LLC or S Corp.
Spreadsheet,
Yeah.
small spreadsheet.
Awesome. All right. So with that, I want to say thank you, everybody, for joining us on today's webinar. Jim, any parting words?
I will have one last shot. Call us on your deals, talk to your realtors and investors in town, and attend an investor club meeting. You'll find these loans. When you find one, call us and we'll pencil out a deal for you. We want to pencil out a deal for you.
Lori, any parting words?
No, just thank you for joining us, and we're here to help anytime we can, and we're ready to work for you guys. Thank you.
Thanks, everyone. Bye-bye.